Growth of the economy is slowing, says our next guest, Chris Retzler, portfolio manager at Needham Asset Management. What does this mean for our portfolios? Which sectors will outperform and underperform? We're going to find out today with Chris. First, a word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you're over 18 and you'd like to open a new account with cash or roll over an existing account, click on itrust.capital/David in the link down below, or scan the QR code here to get started and learn more. And if you sign up and fund your account using my referral link, you'll get $100 in signing bonuses. Chris, welcome to the show.
Thank you for having me.
Thanks for being here. Let's talk about your outlook for the S&P 500. A lot of divergence between the other sectors of the S&P versus the tech sector. It seems to me, just looking at the charts, that the tech sector is leading the pack. Is that an indicator to be either shorting tech or longing the other sectors besides tech? Or do you think it's only a matter of time before they start reconverging?
So I think what's happening with the S&P 500 is you have a few names that are really leading it, delivering a lot of performance, and they are in the tech sector. We are seeing some, tremendous growth within those companies and opportunities that we think are very sustainable for an extended period of time. We think that, some of the other areas, though, the economy is slowing. And while that is, not always great for earnings, that is going to be very helpful on reducing the inflation rate that we've been battling, that has been more sticky than I think many investors had predicted a couple years ago. So the slowdown in, say, industrials and some of the other areas, I think actually ends up setting up well for stocks later this year. So while we get through these summer months, a little bit lower liquidity, the larger tech names are where a lot of investors have been spending their time. But I think that ultimately that would broaden out.
Let's just talk about the economy for just a minute. You said that the economy is slowing. What signs are you looking at that helped you come to that conclusion?
Yeah, so there was a continued hangover post-COVID where we saw a lot of shipping and inventory overbuilds, double, triple ordering by a lot of companies that were quite desperate for a product during the, COVID years, let's call it about 2 years. Ultimately, a lot of that piled through and went into inventory and warehouses. And then the economy began to slow a bit. And so that combined effect has dragged out, the recovery to a more sustained, normalized growth for a lot of companies. As we speak to companies, and we see them quite often, and we've met a lot of them in the last couple months, we think that we're really coming to the tail end of, that pig through a python experience. And then we get to a more normalized level. I don't expect the economy to ratchet back on a J hook and go to the moon. It's more of a U-shaped recovery is what we're thinking companies are predicting. And that process will continue, I think, into kind of, mid second half of this year. And by the end of this year, post-election, I think a lot of companies are going to be in a better position and get back to some more sustained growth.
How is this slowdown going to affect tech, the leading sector of the index right now? Presumably, you've got semiconductor companies that are growing because of macro reasons, because of the AI theme, and I know we'll talk about the AI theme in just a bit. But are these more or less insulated from consumer demand and consumer strength, labor market, so on and so forth?
Well, the beauty of technology is it's always developing, right? R&D is always pushing the envelope forward. So as you modernize and improve products and services, there's always going to be a future demand at some level. And what we're seeing right now is data centers and building out further of, the hyperscalers in preparation for AI. That's really building, the core infrastructure. And then after that, and as that continues, we expect it to broaden out. How do you get to the communications that has these data centers talking with each other at speeds, with literally, higher optical speeds and other interconnects, that will become more important. And then ultimately, you're going to get to the edge, and the edge being things like upgrades for PCs, mobile phones, A lot of devices were purchased during COVID in the early part as people started to work from home. And we're beginning to get to kind of that 4-year, 5-year time period where those types of devices will need to be refreshed. And so there's an opportunity here with AI and what would be needed within those products for a full new refresh to be able to take advantage of what AI is going to present to the ultimate users. So again, technology, we think, is really a higher growth area for the economy. It has traditionally been. We do think that there are these tangential areas. So infrastructure, we think, continues to do well. Military modernization is another theme that we're very interested in here, for unfortunate reasons, but for reasons that are very necessary.
I want to come back to that. Okay, so the economy is slowing down. What's going to happen to inflation? Then ultimately, what's going to happen to Fed monetary policy?
With the economy slowing, but we're not falling off a cliff. We're not staring down a recession right now. We're just looking at a deceleration of economic activity. And so far, it's been very controlled, which is a good thing, in my opinion, that it's going to take a longer period of time, because it's not some irrational collapse. It's not a 2007, 2008 period. It's not the COVID reaction immediately where there's some black swan event that takes the economy down. It's, I guess in many ways you could call it a soft landing so far. We'll see if it ends up being a fully soft landing. But the slowdown and the lower economic activity takes pressure off of some of the items that were driving inflation, one of them being labor costs. I think that has decelerated some, the inflation of that. We should begin to see some reduction in housing costs and the equivalent renters calculation, as it begins to anniversary out some of old higher numbers. So we do expect the inflation numbers to come down, between now and year end. It's the question is at what speed. And I think as those numbers come in and the Fed is data dependent, it's going to come to the favor of lower interest rates. I think two of the outside macro items you need to watch is what does unemployment do? It has been rising. The JOLTS numbers are coming down. And then the third is what sort of currency implications could arise. And what we're seeing is, the U.S. Fed has been, higher for longer, but we're already beginning to see some rate cuts overseas. And so you're going to begin to see some imbalances in the currency markets, which could ultimately force the hand of the Fed as well. So those are the items we're watching, but inflation is the primary.
Couple items you brought up that I'll just point out. So yes, the yen has tumbled to a 38-year low this week. You talked about homes. New home sales data came out today on Wednesday, the 26th of June. Home sales last month slumped, supply more than a 16-year high. So yeah, a lot of the factors that you're pointing to have already been playing out, Chris. Let's talk about inflation. If inflation continues to cool, what do you expect to happen to corporate margins? On the one hand, we've got potentially wages cooling in terms of growth, but do you think the prices can keep up still and outpace the growth of input costs?
So I think you bring up a very good point. Will the companies be able to maintain the margins, right? Are they going to be able to pass through the higher costs, or are there going to be pressure on those products for lower costs? I think companies have done a really good job in becoming more lean during this time period. I think they're very focused on reducing inventories, improving their working capital needs. The cost of a dollar is certainly a lot more expensive today than it was when rates were at zero. So I think management teams are very focused on managing, those items. But there could be a point at which, margins could come under pressure depending upon what type of business you're in. Are you a price maker or a price taker? And if you're a price maker, you're probably going to have, continued power going forward to command, and protect your margins. I think it's some of the areas, where those margins could come down, where maybe you still have too much inventory and now you paid too much for input components that you can't pass along. But I think as they continue to reduce inventory, there's less risk of that to the management teams. But it is something we're watching.
Which do you think will be the laggards of the S&P 500? Which sectors do you think will lag?
Yeah, currently I still think that the financial institutions are regionals are still in a struggle. There's a lot of commercial mortgage-backed securities out there that either need to be refinanced or repriced. So I think that that's weighing on some of the regional banking areas. So that's not an area we're spending a lot of time. Healthcare continues to be a struggle. I think that there are areas in the world that are in geopolitical conflict that had been big producers of drug discovery, and I think that that's been a challenge. And then pricing. Everyone's always looking for lower prices in drugs. It's an election year. And healthcare, unfortunately, is, many times it's paid by either government institutions or by insurance companies. And I think that there's always that pressure for lower prices. So it's been much more of a challenged area.
Do you think that geopolitical tensions will ratchet up? You mentioned that defense could be one of the sectors that you're looking at.
So what we've seen is a deployment of a lot of our inventory, older inventory, specifically to Ukraine. But what we also have seen on the unfortunate night, of the attack of Israel, how they were able to take a lot of those missiles out of the sky. And a lot of that was done with non-traditional methods. We like directed energy, which is basically lasers from a defensive standpoint. There's the hypersonic missiles that we hear about from some of our enemies. One thing that goes faster than hypersonic is light, and that's directed energy. But you also see just improvements in old equipment that needs new technology, new communication, anti-jamming. So there's always this push to, have the best equipment in the field. And there's always that modernization that's going on. And so we think that the dollars that have been given to the Ukraine, we need to replenish our inventories here. And I think that that is still something that is yet to come for years.
Here's a thought, Chris. Do you think a lot of robotics companies can become, if not already, defense suppliers? Tesla, for example, with their Optimus robots. I don't know if Elon Musk is planning to partner with the government on selling those robots as part of a defense contract, but potentially that's possible, right? What's your take?
So I think what you have to be careful with is, there are government contractors that are approved by the government to be suppliers, right? And so I think that tends to be an arduous process. The other side of it is what we've seen in some of the limitations of supplies out of China have been, are you a military supplier or are you not? And so in many cases, you want to bifurcate that, because if you are a military supplier, you may affect some of your other businesses in getting supplies. For example, some of the rare earth materials that come out of China cannot be used in certain areas, such as communication and other military. So there are companies out there that, certainly will benefit from this modernization, but whether you pull together, consumer-oriented, historically oriented companies into the military, I think would be a bigger challenge. I would look more to the traditional Lockheed Martins, General Dynamics, Raytheons of the world to see what they're working on.
Cybersecurity is a theme. Have you looked at that? Just this past week, there's been a series of news items surrounding ransomware and hackers attacking companies, databases. Auto dealers, for example, in North America, had their database provider hacked, and I think the ransomware hackers are demanding, I think, something like $40 million. Cybersecurity as a theme. What's your take there?
Unfortunately, cybersecurity is a very long-term theme. The question is, do you have the right solution for the problem at hand? And the problem at hand continues to change as the hackers continue to evolve. And some of it, will become a much bigger problem when we get to quantum computing, where the speeds that can be used by the hackers against the protections might be overwhelmed. So you do see, a handful of large public companies, Palo Alto, Checkpoint, Zscaler, always improving their, security offerings. But I think you also see a lot of activity in the private company world where they really have to do full redesigns and then either sell themselves or go public. But cybersecurity is unfortunately something that I see no end in sight to.
And it's a longer term theme because it's ever evolving, or do you just not think it's a priority for a lot of companies right now?
I think it's a huge priority for companies in that it is not a nice to have anymore. It is a must have. Headline risks, ransomware, shutting down your operations, attacking the utility grids or other sort of public services are just they're not nice to haves. They're must haves. I do think that some money has been redirected into AI database data centers and so forth at the enterprise level when budgets are a little bit more constrained. But I think as we get through that and those infrastructures put in place, cybersecurity will probably, see an acceleration again.
Okay, well, you run a series of funds. One of them is a multi-cap fund. Tell us, Chris, do you think that the mid caps and small caps are a good buy relative to the large caps right now at current valuations? Just for context, the S&P 500 is up 26% over the last 12 months, so on a one-year rolling basis, while the Russell 2000 is up something like 10% only. There has been a divergence in the past month, like I've noted, a lot of that due to the tech leaders. However, generally speaking, the mid caps and small caps have underperformed the S&P. What's your take there?
So we would expect small caps once we get through this downturn of a U that we've discussed, that they will probably lead the markets out when we begin to reaccelerate and see top line recovery. But right now, the reason why we've seen large caps is there's more liquidity. They're bigger components in a lot of passive ETFs, and so that's also helped to push them up. They have multi-products, multi-services. They can diversify a lot better. And they also generally are not facing funding issues. And smaller cap companies that have been borrowing money, at zero cost for many years, and its growth at zero cost, they're now facing, much higher cost of capital. And so I think that has weighed on a lot of smaller cap companies, those who, need to access the capital markets and, have, more difficult balance sheets than they have had in the past. So I do think that with lower interest rates, that will be some relief to those smaller companies. And we've also not seen a lot of M&A in the last 3 years. And so the small cap area where generally those assets are recycled into larger companies, larger platforms, there's really been a lack of interest in a lot of M&A. And I think that, if there's a change at the FTC or lower interest rates, you could begin to see more M&A activity. So that would also give a lift to that small mid cap area where, that's can be a terminal trade for a lot of companies. Ending their life cycle in an M&A transaction.
Generally speaking, Chris, whenever we have a bull market, which was the case for the last year and a half for the most part, and the small caps underperform the large caps, is that an indicator of more risk adverse sentiment? Generally speaking, whenever we have a bull market, the small caps tend to have higher beta, but that didn't seem to be the case this past cycle.
Yeah, no, the breadth of the market was not as strong as what we would have liked to have seen. But I just think that the money flows have been into the larger cap. They're chasing the momentum, they're chasing the winners. And there's really been an avoidance for companies that are losing money, have challenged balance sheets, have refinancing risks. And unfortunately, a large portion of the Russell indexes have a number of constituents that have those profiles. Now, within those indexes, there are certainly some that have outperformed and there's others that have underperformed. But I think you've had to stay with those that are profitable, good balance sheets, even cash positions, the ability to buy back shares as opposed to having to refinance. And then you just have to look at good management teams. I mean, that's one of our major tenets of investing is, do you have the right team and board in place that can manage through a downturn? You can have the best product or service, but a poor management team and they'll destroy the company. But I think with a good management team and a mediocre product or service, they can survive. They can do well enough.
By the way, just off topic a little bit, do you think private equity capital is a leading indicator at all for small cap performance?
So private equity has had a good time here as companies have had to manage their balance sheets and valuations had come in. I think their financing costs are certainly more elevated, but they raised a lot of money, and there were special opportunities where they were able to either deploy capital into a public company through, say, a convert or some other preferred structure, or they were able to buy the company outright. And we've seen a lot of private equity take out software over the last couple of years. That's one of the few areas that there really aren't antitrust issues when taking out an entire company. But in software land, doing a restructuring in a public forum tends to be a very long and arduous process. And to do it in a private setting, I think benefits many constituents, most of which are employees, and that you don't make decisions for short-term benefits. You're making long-term decisions for the benefit of the whole business. But so, yeah, I do think at some point, private lending is probably going to have its margins squeezed on the returns that they've been enjoying.
And that's not a broad liquidity issue. That's just investors being more prudent, I guess.
Well, I think as the banks begin to lend more, there'll be more opportunities as opposed to the private lenders, which have really been the lenders of last resort to a lot of companies.
Well, let's talk about some tech news and finish off here. So tech, we'll circle back to the beginning. Sector leader for the S&P 500. What happened with NVIDIA in the past week? The stock has very briefly become the world's most valuable company, surpassing Apple. That was short-lived. Now crashed about something like, we're dropped about something like 13% over the next 3 trading days following that particular high. Is this just traders taking profits, you think, Chris, or is there a more fundamental story at play?
I think it's traders taking profits, but I also think it's potentially rebalancing portfolios, where this has been a tremendous winner for a lot of long-term investors or institutional investors, where they're looking at their portfolios and saying, what is this as a percentage of my total assets? And there could be, hey, I have to, pull back on that. It's coming into the end of the quarter, right? The quarter ends this week. So I think that there's probably been some rebalancing. But I also think it's not a long-term negative. I think NVIDIA's position is great long-term, even if there are other entrants that come into the marketplace. I think that there's just so much infrastructure that needs to go into the AI build out, the cloud build out. And so there's room for other players to come in. I think that you also have great new products. I mean, they're on a 12-month cycle, which is almost unheard of in semiconductors. So they're advancing the technology rapidly. And I don't think we're seeing any slowdown in purchasing from hyperscalers. There will be a point at which everyone expects to see a return on investment, but I don't think that is necessary immediately from the end users. I think they're looking at this on a very long.
This is from Jensen Huang, CEO. He's at his latest press conference, he addressed competition. He said AI chips provide the quote unquote lowest total cost of ownership. So the NVIDIA platform is broadly available through every major cloud provider and computer maker. creating a large and attractive install base for developers and customers, which makes our platform more valuable to our customers. Generally speaking, do you think they have a clear leader in this space right now, or as an investor, would you be looking into diversifying into other chips?
So if you're looking to diversify into other chips, I think you have to look at what are tangential around the NVIDIA solution, right? What are the other components that are going into these boxes? If you look at a server, there's a lot of other components in there. And so I think as you do your diligence on what is helping optimize that, is it power management? Is it capacitors? Is it supercapacitors? What are the components in there, and who are the suppliers in there? You've got, a lot of, printed circuit board manufacturers, right? So there's, again, the supply chain into the whole solution that makes NVIDIA work is, I think, what investors are looking at, right? And we're thinking, and we were seeing that was beginning to broaden out, timing devices, how all this works. I'm not an engineer, but for those who are engineers, I think you understand that there's a lot of pieces in there that have to function together to make this work. So I think NVIDIA's position as a leader continues as a leader. I don't see anybody truly challenging it anytime soon, but I do think the market's big enough for an Intel and AMD to have solutions of their own. And as inference builds out beyond, large language models, you're going to have, a lot more activity.
As far as performance goes, the tech sector has run up considerably, as you know. At current valuations, would you still be considering, or would you still consider overweighting tech as an investor, or is it time to take profits, rotate capital out of that sector?
So I would stick with tech. I think that, if some of the Magnificent Seven are very overweight your position, that would be prudent to take some money off the table. But the general themes of what's been driving tech hasn't changed. Semiconductor R&D continues to be pushing. We're going to begin to go to the 1 nanometer, so that means more semi-cap equipment. We think that software has been through a bit of a downturn with the slowdown, but software has high margins, good cash flow. And I think that once that levels out and you set a new floor, those can begin to work again as well. But we need to get through to some lower inflation, which is going to come from slower growth, which we think will persist through the remainder of the year. And then, technology generally has very good moat. So it will probably be able to protect its margins, to one of your questions earlier, better than some of, companies in, say, an industrial area may not be able to protect it.
A final question on AI. Generally, how would you play the AI theme? Now, I've talked about on my show how AI could become a risk to some people in the labor force, but I haven't really delved into whether or not AI could cannibalize existing tech products. Presumably, with AI, some legacy enterprise solutions could become obsolete, or maybe the consumer may not need some Microsoft Office products anymore. Do you think tech companies are looking into that as a threat to themselves?
Yeah, so I do think that you could see some threats within software that, for coding and things like that, that could come under pressure if AI can, progress that along. I think one area is like drug discovery is going to be interesting. How does AI have a play in that? Does that, weigh on certain tools that might have been bought in the past, but now are going to be done through an AI process? Are there services that are going to be obsolete because AI will be able to take care of it? Does teledocking go to something different because now you're going to have AI solutions at the front end before you need to go see a doctor? So I do think that labor will be impacted. But again, one of the issues we have here is, not a high enough unemployment level. And are you recycling those resources back into new areas? It's the old adage of, recycling, people, resources, and then redeploying them to areas where we need them. And it's never an easy, it can be a very painful process if you're a part of that transition. But it is how the economy progresses forward, and technology is at the forefront of moving that.
Okay, excellent. Chris, thank you very much for your time today. Where can we learn more about your work? Perhaps follow your funds?
Yeah, the needhamfunds.com. I think you can find all the information on our mutual funds.
Okay, perfect. We'll put a link to that website in the description down below. So make sure to check that out. Thank you very much, Chris, for your time. We'll speak again soon.
Thank you very much.
Thank you for watching. Don't forget to like and subscribe.